Welcome, everyone, to a special Directed IRA webinar and Directed IRA podcast episode. This is Matt Sorensen. I'm going to be your host today, and I am excited to welcome Dave McAlvany with us today. Dave is a advisor. He's worked in the precious metals space for quite a while. I'll let him get into the details on that. But we're going to be talking about buying precious metals in your IRA, gold, silver, all these other, we'll talk about what kind you can buy here in a moment. But also maybe this is going to be applicable to some of you buying precious metals outside your IRA. We're going to be talking about just the asset class in general. So David, thank you so much for being with us today.
Matt, great to be with you. Thanks for the invite.
All right. Well, first, I'm an attorney, so we're going to do a disclaimer here. If you guys can show this on the screen, keep in mind today is meant to be educational in nature. This does not constitute financial advice, legal advice. We just want to give you guys great education about the things you can invest into. Do your own research and due diligence with whoever you're using and working with, whether it's us or Dave McAlvany or anyone else. We're just trying to provide you great education here today. All right. Well, let's jump into this here. Dave, why don't you maybe tell me a little bit about yourself and how you got into the precious metals space?
So I'm a second generation family business owner, and my parents started the business in 1972. We were early in the precious metals space, and actually at a time when it was not legal to own gold and silver. So
it was a collectible.
That's right. You could own jewelry, you could own a collectible coin, but you could not own bullion. And that had been in place. Those rules have been in place since 1933. My dad worked with Senator Jesse Helms to get gold legalized, and that happened January 1st, 1975. So we had kind of a first mover advantage in the gold business, and we provided metals to about 1,200 different Wall Street firms. So we started as a wholesale firm providing metals to the investment space.
Now, you guys were pretty early with IRAs as well. Why don't you talk to me about that and how that came about as you were, selling IRAs to Wall Street and, I should say precious metals, but how that come about where IRAs actually ended up investing and buying precious metals?
Yeah, the legislation shifted in 1986, if I'm not mistaken. And that was the first year we put physical metals into IRAs, and not a lot of competition at that point. Again, kind of an innovator in the space. So we've been doing that since 1986.
Yeah, I don't know if it's true or not, but I've heard from other people that you guys were like the first to do that.
Innovation has always been something that we've prided ourselves in, and we've done a lot of business in the IRA space. And so, physical metals, gold, silver, platinum, palladium, those are the metals that we've focused on, and have worked with thousands and thousands and thousands of clients.
Yeah. So for anyone listening here that's unfamiliar with it, this is something your IRA can actually own. There's restrictions in the IRS code about the Internal Revenue Code about what your IRA can and can't own. And one of those restrictions is collectible items. But there's an exception to this restriction that says certain qualifying metals, gold, silver, platinum, and palladium that Dave mentioned right there, can actually be owned by your IRA as an investment asset. And we're going to get into that through the day and some of the storage rules and some of the things like that, what to watch out for. But let me just give you a preview of what we want to talk about. We want to just talk about this asset class in general. And I'm going to just turn it over to Dave here to kind of do some teaching and education on it. This is something he's way more knowledgeable about than I am. But we want to talk about why are people buying this basically as an investment in general, whether it's in their IRA or outside of it. I want to get into what you can do in an IRA. What are the qualifying metals? What are some of the storage requirements? What if you're trying to create a portfolio of precious metals? How do we think about that? What metals should I be buying? Should I be buying different metals? Should I be buying all the same? What are some of the market trends and risks and opportunities that are out there? We're also going to hit some of the scams and due diligence we want you to do out there. There are some bad actors in the precious metals space, as there is in many asset classes. So what are the things to look out for there? And then at the end, we will be taking your question and providing some answers. So if you have any questions, just hang tight, write them down. You can even throw them in the Q&A in chat. We got Aaron, the great and powerful here, Aaron Halderman, our COO, who will be pulling some of those towards the later hour here. So Dave, let me just turn it over to you to just get into teaching us about precious metals. I'm going to be here interjecting every once in a while, but we're going to go ahead and spotlight you and just take the floor, if you will. I know you got some stuff prepared as well.
Matt, I think the best way to see precious metals is how they complement an overall portfolio structure. So as an asset diversifier, it plays a unique role within a portfolio. You've got growth and income assets. You've got, cash assets, which are there to either be able to buy assets at cheaper prices or to, if you're managing outside of an IRA, you're managing a household or a small business or what have you. We see precious metals as wealth insurance. And so they play a unique role in that they are countercyclical to stocks and bonds. They tend to do well when stocks and bonds are not doing well. And they also create something of an offset for when you're in periods of higher inflation. For the cash assets that you have, they kind of serve the insurance role both for your stocks and bonds, but also for your cash or liquid assets. So think of it as an asset diversifier. Think of it as wealth insurance. And there's periods of time where that becomes more of a focus for investors, and there's periods of time where it becomes less of a focus. We refer often to what we call our perspective triangle. And this is just a basic asset allocation model where, at the base you have insurance. On the right-hand side, you've got cash or cash equivalents, and on the left-hand side, you've got your growth and income. And this triangle can be, the isosceles triangle, if you go back to grade school, or an equilateral triangle. But, you're looking at it and trying to say, what am I asking my money to do for me? And to have a different expectation, to have a different mandate for your assets, I think is important. Some people look at gold and silver and say, well, we've had a great growth streak here in the last few years. And I would say that's wonderful, but really what that is an indication of, it's a signal of concerns by investors. That could be concerns with public policy, international relations, concerns about our money. And it was just a year or so ago that we were, edging up in terms of inflation rates. And those factors drive investment demand for gold in particular.
Yeah, we do see people, I hear about people that, they're trying to like time the market, and they're like, well, when the market's going up and everything, I want to be in equities and stocks. And if I think the market's going down, I want to get over to like gold or silver even, and this is like, I know a lot of people think of it as like a hedge, too, to own like the stock market, public equities, and, precious metals. But I mean, how do you think about that for people trying to like actually build wealth, for the long haul? Like, how should people approach thinking about, all right, I've got a lot in the stock market. Maybe I own some real estate and I haven't invested in precious metals yet. How should they be thinking about getting into it? Is it a timing thing? What should they be thinking about?
Yeah, Matt, I think that's a really critical question because when you look at metals, they, on the one hand, are a diversifier. But if your goal was to grow wealth through time, you could actually increase your returns and decrease your volatility by having an allocation to physical metals. We did a number of research projects back in the late 60s, and then we did this again, 2019, 2020, and came up with the same conclusion that if you had a growth-oriented portfolio, and 75% of that was allocated to stocks and bonds, 25% was allocated to gold, then you do a rebalance once a year, you do a tremendous favor to yourself, to your portfolio in terms of growth. What that looks like is this. In years where equities have outperformed, you're basically trimming the gains and buying the cheaper asset, right? Mm-hmm. And in years where equities underperform, gold is outperforming, you're trimming the gains from gold and you're lowering your cost basis in your equity. Yeah. And so you end up reducing the downside.
So you're kind of like selling high and buying low, switching the asset class a little bit, because in that example, the stock market's gone up, so you're kind of selling high, but you're buying back low when gold's down.
That's right.
Genius. So that sounds pretty smart.
The annual rebalance is really key to see how, again, you can be growth oriented, still have this insurance play, and no, it doesn't produce any income. So it has some disadvantages, but it does have this counter-cyclical behavior. And, it's a little bit like if you go back to the Peanuts cartoons, Linus liked his security blanket. There's periods of time where people want a little bit more security, and they turn to the physical metals for that. And that's typically periods of time where there's a drawdown in your traditional asset classes.
Yeah.
So to be able to buy low in those traditional asset classes, taking some gains from your metals, it means that your time to recovery is reduced significantly, and your growth component, you're adding horsepower at lower levels. Whereas a lot of people, if they're 100% invested, they just have to play the patience game and wait for a recovery after a downturn.
Let's talk about some of the tax benefits here. Maybe we can focus on IRAs for a second. Um, I know the collectibles have like a little bit higher capital gains rate at 28% on the long term. You don't get that 20%, kind of lower capital gains rate. So as you're buying and selling precious metals personally, having gains, you're making money, but you're paying a 28% long-term rate. But when you're buying and selling in your IRA, if you're coming in and out of the asset classes you're talking about there, maybe on an annual basis doing that rebalancing, there's going to be no tax. So you're capturing all the gain and building it up into the IRA. When do you guys, and now you guys have a separate wealth management company too, but when does someone think about using their IRA for this to go buy precious metals versus just buying precious metals outside their IRA or 401k?
Yeah, I think about owning precious metals like owning a bag of golf clubs. There's a variety of clubs. You use them for a variety of reasons. Some people want physical metals in their hand, and that may be something that they have sort of in case of a worst case scenario.
Yeah.
That is a different motivation and a different mandate. It's like the sand wedge. If you find yourself
Yeah.
in the sand pit, what do? You don't
Yeah.
bring a driver, that's for sure. But I would look at the IRA as a more optimal way of being able to trade a portfolio. And so, portfolio construction comes into play. Like, what is the appropriate percentage between gold, silver, platinum, and palladium? And are there ways to sort of optimize the ratios between those metals? And this is something that, after 53 years of being in the business, sets us apart a lot in the industry, is we bring strategy and tactics, and it's not just sort of a set it and forget it. So we can optimize growth within the metal space in addition to being able to balance out your physical metals holdings with other assets as well.
Yeah. So I think that's a good, let me just kind of highlight a couple of things so people understand some of the rules is, when you're buying precious metals in your IRA, and Dave's mentioned those four metals, gold, silver, platinum, palladium are the ones that you can buy, but there is a storage requirement. You can't store these at your home. Okay. These are not in your personal physical possession. So these are being stored at a depository, and there's regulatory licensing requirements, then the tax code for that on how you do it. We use Delaware Depository here for our customers that are buying precious metals with their IRA. And so you're buying it for investment purposes, not to have it in your hands. You might have that motivation to be like, all right, no, I want to have this like under the mattress type stuff or like at the safe at the house. That's metals you're going to be buying outside your IRA then. So then let's get into kind of that portfolio construction. So what is the most popular precious metal? Is it gold or silver? And we don't see a lot of people buying platinum and palladium, but I know you guys actually play in that space a little bit. So maybe let's talk through the different metals and what's popular and maybe some of the attributes of why you're seeing people buy the different ones over the other.
Well, we come back to the mandates, and if the mandate is insurance or wealth insurance, then gold is the very best. It is an asset that can perform well during periods of inflation, during periods of deflation. It's kind of the all-weather metal.
Yeah.
It's also the metal.
It's the reason, there's a reason you get it for taking first. It's the gold medal.
That's right. Gold speaks for itself. It's also the metal that central banks tend to accumulate. And, the last run up in gold has not been driven by investor demand. It's been predominantly an outsized appetite for gold by central banks. And they've decided after many, many years that they want to diversify away from the US dollar and out of US treasuries. So they're creating what was, 300 to 500 tons a year demand. Now it's close to or over 1,000 tons a year. That's 3 years in a row. Central banks have been defining the price structure of gold. They're not interested in silver. And a part of that is because it takes a lot more space and the logistics of storage are much more difficult.
Yeah.
But within an IRA, you don't have to be concerned about, I mean, that's where working with Delaware Depository, it makes it really easy. You could have $1 million in silver and it's not, it's not going to, crack your foundation.
Hmm.
Dollars in silver, took delivery of it. It's sizable. It's several tons.
Yeah.
So I think the portfolio construction that we see to optimize growth, and you have to kind of balance what do you want? Is this a pure insurance play? Then the all-weather metal is preferred. And we would sort of recommend a 70-30 split between gold and silver. To the degree that investors want to bring in a growth component, then you look at how those ratios, how the metals trade in relation to each other. This is really simple math. Just take the current spot price of gold and divide by the current spot price of silver. That gives you a ratio of how many ounces of gold equal ounces of silver. 1 ounce of gold today equals roughly 100 ounces of silver. If we looked at 600 months of data, and only 1.8% of the time have we been this high in the ratio, which to us tells us that silver is dirt cheap relative to gold. And so for someone who's looking to arbitrage the value play here, you might consider, instead of that 70-30 mix, a little bit higher percentage in the white metals, silver in particular. So there's a way to capture gains and compound your ounces by tilting or favoring the better valued metal. And platinum is also a metal that is in the portfolio. We typically limit it to between 5 and 10% of the value of an account. The reason for that is it is strictly an industrial metal. So the history of gold and silver are as money. 5,000 years we've experimented with this through ancient Greece and Rome up through 1971. Gold and silver were treated as money within the global system. And it's only in the last few decades that it's been relegated to the category of a commodity. But that's its history. When you look at the platinum group metals, doesn't share the same history, purely industrial in use. So if you get into a period where you have recession or stagflation, there can be headwinds to the platinum group metals that are not suffered by gold and silver. So we want to make sure, if the mandate is insurance, that you don't overexpose yourself to something that has an economic sensitivity that's not going to be working to your benefit. We do like the ratio trades, and we've done this very successfully between platinum and palladium. Biggest use for platinum and palladium is in catalytic converters. And so if you're looking at the internal combustion engines for gasoline versus diesel, there's a preference for one versus the other. So you will see purchasing managers by the big auto companies favor one versus the other. It creates volatility in the platinum group metals, and we can compound ounces and grow that ounce position over time. The most recent trade was coming out of palladium into platinum, and we increased our ounces by 300%. It was a great trade, but you had to have at least that 5 or 10% exposure to benefit from it. We also note that platinum is trading at a discount to gold, where for most of my lifetime and yours, platinum was trading at a premium to gold. So there is a relationship there that suggests maybe an undervaluation. Certainly concerns exist about electronic vehicles or EV.
Yeah.
And will that sort of displace the ICE engines, the internal combustion engines? Is this a trade which is now going away? And that's probably a longer conversation, sidebar. We like the focus on the gold and silver piece because of their monetary history, and that's where our focus remains primarily.
Um, Tell me about what you're seeing right now, like right now in the market, is like any trends or things people should look out for. I mean, we kind of got into this as I was refocusing on precious metals, um, because we were kind of looking for someone that we could work with, that we felt good about, where I want to get to due diligence and stuff later. But We stumbled onto some of your guys' content and had some connections to you guys and some of the great things you guys had done, the reputation you'd built. But like right now on the market, gold has gone up pretty significantly, and silver. They've outperformed the stock market, in the recent history. Stock market's had a lot of volatility this last year. People are a little concerned. I mean, do you guys get increased demand when like precious metals are going up? I mean, in many ways, you want people to buy when it's down. But I'm just thinking like right now we've had a good run. Is it still a good time to buy right now? Um, you always hear Warren Buffett talk about, investing and trying to time the market with the stock market and just being like, you just can't do it. It's impossible. You just got to get invested. You have to get into the market. But what's your perspective on that, given where we're sitting now with gold and silver have done really well this recent year?
They have done very well. And, it is ideal to buy low and sell high.
I mean, we should have had you guys on last year, pretty much.
Or 5 years ago. I mean,
yeah, even better.
Yeah, I think that if you're going to take a position in gold and silver, that annual rebalance and being able to shift ounces to shares when the market is down, when the equity market is down, it adds a tremendous value to sort of an unemotional approach to and a disciplined approach to managing wealth through time. And I think what has driven the price of gold to these levels, these are trends which are not going away anytime soon. We have the central bank community, which is interested in diversifying away from the US dollar. We've got our trade partners in light of the tariffs and trade war, if you will, looking at the US dollar as a means of transaction settlement and invoice settlement through a very different lens. And whether it is a focus on the BRICS nations or just the non-dollar bloc, there is a desire to move towards more of a multilateral world instead of a unilateral world. And the dollar has been sort of the monetary hegemon for a long, long time. And there's some question as to whether or not that remains the case. We don't take kind of a worst case scenario view, but we do see shifts in that direction. And so I think the trends that we're talking about are structural in nature and long-term or secular in nature as well. We're talking about sort of replumbing some of the world's financial systems. And this is, at least for the next 4 years, somewhat a reaction to or a response to the Trump administration and sort of the hard tactics that are being put into place. Just last week, 50% tariffs on the EU, and now it's not going to be 50; it'll be something less than that, at least until July 9th. And it's kind of on and off, and what that's doing, Matt, is it's creating uncertainty, and the financial markets don't do well with uncertainty. Mm-hmm. We do have the stock market trading near all-time highs. So I think the next leg of growth in the metals will come from investors following on the coattails of central banks. And investors will have several reasons to do so. It may be concerns about the buying power of the US dollar. I mean, if you listen to Treasury Secretary Bessent, he's basically made clear that a weak dollar policy is a part of us gaining a trade advantage and improving the terms of trade, where we don't have quite the trade deficit or the imbalance with massive trade surpluses building amongst our trade partners. So a weaker dollar policy has implications for U.S. savers. So that's going to be one response by the investment community. Another response will be continued volatility and lack of clarity as to where we go from an economic standpoint and where the markets go from a growth standpoint. We are, if you're looking at sort of standard deviations, we're in the 2.5 to 3 standard deviation range above the norm in terms of valuations for U.S. stocks. We're pretty expensive.
Yeah.
Basically, there's only about 1 to 2% of all time in U.S. financial market history where stocks have been more expensive. In the other way of saying that is 90% of the time they're cheaper. You're in the rarefied air of super expensive. So if there is some sort of a cause for market volatility where we see a drawdown in the NASDAQ, the S&P, and the Dow 10, 15, 20, 30%, investors will look for that safe haven. And what is different this time is that treasuries have traditionally been one of those safe haven plays. And yet we're in a position, if you look at US debt and the way the world is treating the treasury market, it's with a little bit of a concern. It's not what it used to be. In fact, you could go to Europe and their 10-year treasuries are trading at 2% less than ours. They yield 2%, ours are 4.5%, and yet we're supposed to be the benchmark for the quote unquote risk-free rate. Well, why are we basically double the yield if we are the benchmark for risk-free rate? Well, all that to say, the world has already concluded that the treasury is not what it used to be. So I think the next round of volatility in equities, instead of driving tons and tons of money just to treasuries, I think a lot of that's going to go to gold too.
Interesting. What do you think about crypto? I think I totally agree. Like the ratio in the stock market, the price to earnings ratio you see for companies is at ridiculously high levels than what you've seen in the past. And a lot of people do have that sentiment that the stock market's overvalued. It's why a lot of people come here to directed IRA to open up an account to invest in some private asset. They just think there's more value there, whether it's real estate or a private non-traded company, a private fund. They're probably doing private lending, they're investing in crypto, they're buying precious metals, whatever maybe they just feel like there's more value there in that asset, and they worry about the overvalue of the stock market. But crypto has just been, came out of nowhere in the last 10, 15 years. I say 10 years. And a lot of people have tried to say, well, Bitcoin is it's digital gold now. This is the new store of value. What's your perspective on that and compared to like actual physical gold, right? And are you seeing people do a little bit of both where they are trying to go to crypto there's been a lot of new money going to crypto instead of precious metals? Do those two assets compete against each other for being like the option from the stock market? What are you seeing with crypto and seeing from investors, other smart people you're talking to?
Yeah, well, the one commonality that crypto has with the precious metals is the scarcity factor.
Yeah.
So you've got a limited quantity, and so if demand increases on the basis of limited supply, you're going to see price appreciation. What we haven't seen is how crypto works through a complete credit cycle. Where all of a sudden interest rates are very high. That represents headwinds to corporate growth. What does a risk asset do in that context? And I would make the distinction between cryptocurrencies as a growth asset, as a risk asset, versus precious metals as an insurance or hedge asset. We have the safe haven play, and just since the sort of retraction of the tariffs, we've had Bitcoin move 40%. Right. So all of a sudden it's sort of risk on, and the NASDAQ has rebounded from being down, 15, 20%. It's now recovered its losses for the year. Bitcoin was down 14%. Now it's up over 14% year to date. So it's behaving like a risk asset. And I think it's appropriate to have an allocation to it. Just make sure you come back to that mandate question. What are you asking your assets to do? And if you want a hedge, if you want an insurance play, if you want something that is a safe haven, the metals provide that, which is different than your cryptocurrency exposure, which would be competitive with a small cap stock. It would be competitive with any other form of risk exposure.
Awesome. Well, I know you had some stuff prepared. You have some charts and stuff you wanted to share. I've kind of started, imposing my questions here, what I wanted to get us through out of the gate. But I want to just turn it over to you to kind of share what you want to on anything on precious metals. And then we'll be kind of digging through some Q&A here. I know we've already been answering some stuff in the chat. I think we've dropped some of your guys' contact info in there as well. But I'll let you have something that you want to kind of get to, David, we didn't talk about. I want to get into some due diligence stuff too, and we'll get to Q&A.
Yeah, just to kind of visualize that investment triangle, the perspective triangle. This is how we see things. You can see the perspective triangle there. Great.
Yep, we got
So
it.
there at the base, you have insurance. Off to the right-hand side, you've got cash, treasury bills, money market funds. And, I didn't include crypto in that third segment, but you could. Stocks, bonds, mutual funds,
Yeah.
annuities, more of your risk assets. So with that kind of a framework, you have the ability to look and say, I have different expectations of what different resources are doing for me. And, on the cash side, a lot of folks on Wall Street really play down the value of cash. And we would have sort of strong disagreement with that. We look at the optionality of cash and see that the best way to make money is buying things when they're cheap. That means you have to have some flexibility to do that. Wall Street prefers that you're 100% invested 100% of the time. Make the claim, you can't time the market and all this. That's great. But the reality is you get into a position where you have significant drawdowns, and these can be based on macro factors. What do you do if you're inadequately reserved in terms of your liquid position or inadequately protected in terms of your safe haven assets there at the insurance base? You don't have a lot of flexibility, and you are just forced to play the patience game. So, we find a lot of folks in their 50s, 60s, 70s, they don't want to go through another global financial crisis. They can't afford, in terms of the time frame and what it takes to get back to recovery, they can't wait 5 or 10 years to get back to break even. So making sure that you are adequately positioned with liquid assets, both cash and gold, I think is really critical. We talked about compounding ounces, and this is what we do inside of an IRA in particular, where think of us as metals agnostics, and we don't really care what the metal is. We're going to look at the value equation, and if cheaper product is on offer, that's probably where our focus is going to be. So at 100 to 1 on the gold silver ratio, silver makes a lot of sense. Maybe instead of that 70-30 mix, maybe it's 50-50. I mean, we have some clients that even skew it the other direction and go 30% gold, 70% silver. Then when the ratio begins to drop, you move from the silver ounces into the discounted asset, that would be gold, in that future scenario. So being able to compound your ounces, this gets around the chief criticism of physical metals, which if you go back to the late 90s, this is where Warren Buffett had a huge position in silver. He got rid of it. He's like, look, it's a dead asset. It doesn't produce any income. Why would I want it? I want to own a productive slice of America. The best economy in the world, the best currency in the world. I'm not going to hobble myself. Well, he's not looking at this kind of an arbitrage. And if you can internally compound your wealth over time using things like the gold silver ratio or the platinum palladium ratio, then all of a sudden you do have a productive asset. And it's a hard asset serving the purpose of insurance. So this is I think a better way, and it's certainly a better way for your IRA, where you can have the best of both worlds: physical, tangible insurance, but with a growth kicker. Other charts that I think are important to share. Let's look at just the difference in over a long period of time, 1970 to the present. If you're doing the ratio trading strategies versus you just have a static gold silver portfolio, you've got gains in a period of time, but you're able to enhance those gains by trading the ratios and improving your total performance. A couple of things I'd love to share.
Let me ask you this before you jump to the next one on this. You guys are doing this more portfolio construction. You're not just like selling metals necessarily. I mean, you guys sell metals, but I mean, you're really taking an active role in trading the metals out. And as you said, kind of, when gold's up, go buy silver and it's cheap. When silver's up, go buy gold when it's cheap, and kind of and arbitraging that a little bit might not be the best word, but kind of maximizing the value for your long-term growth. And that's what that chart was showing there, the difference of just set it and forget it versus being conscious about where the values are and but taking action too. And so, I mean, is that something you guys are doing? Are you alerting your customers to that? Are people, this is like a tip for people to aware of? Like, how does someone effectuate that in their portfolio?
Yeah, so these are individual retirement accounts. They're self-directed. We do not have discretion over the accounts. And
Yeah.
so this is done in a cooperative fashion with one of our advisors who will show you the math. Say, here's where we started. This is why we constructed the portfolio this way. We looked at the ratios on the front edge. Now the ratios have shifted. Here's a beneficial trade for you to be able to capture additional growth. I'll just give you one example, and this is a product specific thing, but this is the historical premiums on Silver Eagles. Occasionally you can get them on the lower end, 10-15% over the spot price.
Hmm.
And when they get to these kinds of levels of 40, 50, 60% premiums, which is unnatural. I mean, you can see from this period of time, it's very unnatural for it to happen. When it does, we're the first to call you and say, look, we could move from, a couple of boxes of Silver Eagles, 500 ounces to a monster box. We could move those in the direction of 1,000-ounce silver bars, and you're going to increase we're just taking the premium. So this is
Yeah.
different than gold versus silver. This is just within silver. If we can buy them cheap enough, then we'll position a part of the portfolio in Eagles. And when you get premiums, this last big push in 2022, we gained a ton of free product for our clients. Now, part of what this requires is that we charge reasonable fees at the front end. We're not charging a management fee as time goes on. The only time you are charged an additional transaction fee is when there is an accretive trade to you, and we've
Yeah.
got to provide the math. So that's what an advisor would do, provide the math. Is this compelling? Do you want to move forward? If it's a yes, then we do the transaction.
Yeah, I think that's really interesting for people that aren't too familiar with metals. There are like these American Eagle in silver and in gold. Right? There's the gold American Eagle, and those will trade at a premium of what the spot price is of metal in general. And so you're even looking within that metal category itself of just silver in that example of where the American Eagle is trading versus just a bar, I guess bullion of silver, and making that trade, which I've never heard before, actually. Sometimes we see the American Eagles and stuff come in and out of people's accounts at a huge premium to what you'd see the underlying spot price of metal. And so you have to be aware of that as you're out there in the market. And I think your stat and graphic there too, I'm surprised to see how much that premium can sometimes be actually.
Yeah, no, no, this is one of the things that you have to be aware of is, metals, the safest way to invest in metals is just to buy generic bullion bars.
Yeah.
There's no confusion about what the price is that you're paying. If you buy a 10-ounce gold bar, you've got 10 times the current spot price plus a very small premium that you pay, which is the commission or the transaction costs, and that should be, we see competitors charging 15, 20, 30, 40% for generic products.
Yeah.
And the way they get away with it is they confuse the math. They like things like, 1.5 ounce Silver Eagles, where, well, is silver $30 or is it $45? And they may charge $80 for it. And they confuse the math and get away with what is highway robbery.
Yeah.
So the safest way is just to pick generic bars and call it good. If you're engaging with someone that you believe to have integrity, then I think you can engage with these kinds of strategies. And of course, this is a service that we offer. And now you have the ability to compound ounces using the premiums and using the ratios to increase your ounces over time. I put the gold silver ratio up there because again,
Yeah, sure.
you see the volatility between the metals, and even if you're in a bull market in precious metals, there is a price difference between the two, and this is what you're trading against to grow those ounces. It's a very, very powerful thing to do. And I outside of IRAs, there's ways of doing this as well, but of course you've got the tax consequences. One of the amazing things is, you go back, I'm sure some of your viewers today will remember 1964 was the last year we had silver in our coinage.
Yeah.
90% of the content in a dime, quarter, 50-cent pieces, those don't go into IRAs. We wish they did. Maybe we can lobby and
Yeah.
but they haven't been made, so there's a finite amount of them. It's 10% copper, 90% silver. When there's demand for silver, those premiums will rise to 10, 15, 20%. And outside of an IRA, we do a lot of this as well. And there's been 5 of these transactions with junk bags since 2009. In total, we've been able to double the number of silver ounces our non-IRA customers have using the bag to bar trade.
Hmm.
It's absolutely fabulous. Now, if you factor out the taxes, it's not a double, it's about a 65% gain in ounces.
Yeah.
You do the math in
This
terms
is
of what
outside the IRA.
that's outside of the
Yeah.
IRA. But with the Eagles, you've got premium potential like those bags.
Hmm.
And so that's what we're looking for is opportunities within the space
Yeah.
to maximize exposure.
And one of the things David's highlighting there, just so everybody's staying with this, I mean, he's an expert in this. I'm at least familiar with the rules for the IRAs. Is like, like the Eagles you can buy in an IRA, silver, gold, like the American Eagles. You can also just buy the metal itself and bullion. You don't have to buy the actual eagle. But once you get outside the IRA, there's other metals that you can buy, whether it's the junk bag you're mentioning, the the silver coins that we've had. And so there's those type of trading strategies you're going to be doing outside of the IRA. And there's tax on that, so that does eat into your profits. But just keep in mind, for your IRA, just did want to note that you can actually use you can do that American Eagle strategy we're talking about.
Yeah, I wanted to share this because I think, we get lost in the price, and gold at, $3,300 an ounce is expensive. I don't think the trend is done. And we do see, I could construct an argument for gold trading to $5,000, $7,000, $8,000 an ounce before this bull cycle is done. But more important than the price is what those ounces buy you, whether it's square feet, whether it's acres. In this case, it's shares. So again, we like ratios because the math is very clean. Take the Dow Jones Industrial Average, and this chart goes back a long ways. This is 125, 130 years worth of data. And what you have in this picture, this is I think the most helpful thing I can share with you today. Why do physical metals factor into your portfolio structure? Here's the 1920s, the roaring 20s, we get to 1929, and we go through a significant market correction. This is 18 to 1. That is, you take the Dow Jones Industrial Average, divide by the price of gold.
Okay, so
Your shares would get you 18 ounces of gold. By the end of the market, where gold has moved higher, equities have moved lower, you're at 2 to 1. It actually, for a day, got to 1 to 1 on the ratio. So to be able to diversify your ounces back into shares, you're buying stocks at an 89% loss, except that your gold has grown too, so that there's a force multiplier in terms of your purchasing power. Now you go through the next major bull cycle, and it doesn't end until 1968. And this ends at a 28 to 1 ratio, right? So now, again, if you can either do the once a year rebalance, or if you're playing sort of the macro trends, if this is sort of a long-term trend that you want to play, look for market tops, be diversifying out of your equities back into gold. This ratio tells you exactly when to do it. Now you own a lot of gold, and you're using the gains that you have in stocks to own a lot of gold. You get back here to 1982, we're back to a 1 to 1 ratio. 1 to 1, right? We got to as high as 43 to 1 during the tech stock boom. And during the global financial crisis, we got as low as 6 to 1. I think we would have seen 3 to 1 on the ratio during the global financial crisis. What we had unfold was unprecedented in terms of the various quantitative easing measures and massive cash infusion that we had coming from the Federal Reserve and the Treasury and the accommodations to keep the system from kind of coming off the tracks. So 6 to 1 is where we were at the bottom of the global financial crisis. Stocks in crisis, gold, that insurance play, doing its job. We got to about 22 to 1 at the most recent market peaks, 2021, and we're sitting currently at about a 12 or 13 to 1 ratio. Again, we're comparing the Dow Jones Industrial Average to gold. Where these trends end is, and these are secular long-term trends, closer to a 3 to 1, 2 to 1, 1 to 1 ratio. To be able to take your gold position, pare it back, cut it in half, and take those ounces and buy shares at historically low valuations sets you up for tremendous intergenerational wealth creation. So to me, this is the most important chart because it ties in why you ask your resources to do different things for you, why you would want gold, because it's not as if gold is going to outperform stocks in every cycle, in every period of time. Stocks are a great thing to have. But there are these periods of significant drawdowns where being able to either move cash into shares or ounces into shares are something of a multiplier for you.
Yeah, I mean, that's super interesting. I think a lot of people are always trying to compare buying stock instead of buying precious metals. And it's like the message is buy both. It's just when do you buy and looking at that pricing discrepancy. And I liked how you said it earlier about buying it when it's on sale or when it's at a good value. And I've never thought about it actually from that perspective. But I think that takes people, having working with someone that knows what they're doing in this space, being engaged themselves and up to speed on that, and understanding those opportunities and when to take action and when not. But let's talk, Dave, if you don't mind. I just want to give my perspective for a second. I'd like to hear your thoughts too on people out there as they're buying precious metals and who you're working with. There's been some guidance out there from government regulators on making sure you're working with people that aren't charging ridiculous premiums on the precious metals, price shopping, that type of stuff. There are operators out there in the precious metals space, as there are in many other categories or investments where there are people that will take advantage of you and that will charge you as much price as you will let them charge to buy precious metals from them. So make sure you're doing your due diligence. That's not our job at Directed IRA. We can't give you advice one way or the other to be like, hey, that's a great price. That's a bad price. Like, frankly, our hands are tied from saying one way or the other. But we do know that there's better companies to be working with than others. And we have seen some of the regulatory notices out there. So just take that into account as you're working with anyone and buying the precious metals. This isn't meant to be an endorsement for McAlvany. Please look into them and Dave and their team and what they're doing. But what's your perspective on that? I know you guys have been in the industry for a long time. So, and I know you've seen some of the other competitors that you have to play with, but I don't know if you have any guidance for people there and who they're working with when they're buying or selling their precious metals.
Yeah, I mean, who you're working with, finding good people is I think a key aspect to success in any part of your life endeavors. Whether it's finding a great business partner versus someone who's contentious and litigious, that finding good people makes a huge difference. And, we have been around for 53 years. We charge reasonable fees. We're definitely not the cheapest in the industry. Within an IRA, our max cost is 6%. And, we definitely sharpen the pencil if you're talking about, orders at significant scale. So there's some room to maneuver there. But you do find a lot of our industry competitors charging 10, 20, 30, 40, 50%.
Yeah.
The most egregious I've seen in the last 12 months is a 70% commission on a standard bullion product. And again, clients didn't know what they were looking at. They were very afraid and concerns about, this or that. And they stopped doing the math and they stopped asking critical questions. I think as a rule of thumb, if somebody is advertising on national television, if somebody is advertising on national radio, those spots come at a very high cost. The radio spots. We've looked and we thought, no, we would have to shift our business to be able to market in these ways. You're talking about $1 million a quarter to be on with a Glenn Beck. You're talking, massive fees, and guess where those fees are coming from? That those are coming from the hides of their clients And I really don't think that the folks on radio and TV know what they are doing to foster something that is very egregious. But it's not, you just have to be aware because this is not a regulated space. We don't have an SEC, we don't have an NASD that we're accountable to. So you're either governed by rules within, because there are no rules without. Our sister company is an asset management company. We are very used to the accountability that comes from, reporting and compliance with the NASD and SEC. And so we operate with a comparable mindset where we assume that every detail is scrutinized. We assume that the math has to be always documented and disclosed. And, if a trade is not accretive, it's not done.
Yeah.
So asking hard questions you just have to do it. So buyer beware in this space, find good people. We're not the only ones out there, but I would say I can count on two fingers. And there's two people that I would work with in our space out of a dozen.
Yeah.
The rest, you are at risk.
Yeah. I mean, we've had great recommendations from you again. And so, and heard of your guys' reputation out there in the space. And I think that's for anybody doing business, for any other party, is reputation matters. You guys have been doing it for a while, so I appreciate that perspective on it. And I think, when you're buying precious metals, we've talked a lot about the premium or kind of what's going on in the market, make sure you're buying right. But there's also that premium that someone may be charging you. And a lot of precious metals dealers will charge you as much as they can get away with. And so just be careful on the ones that have the flashy marketing and stuff. Look at the pricing that you can get and maybe price shop and compare that a little bit as well. Because this is all the same thing. They're selling the same thing at the end of the day in terms of the metals. Now you got to get the strategy right too to get to the next level. But appreciate all of your thoughts here. Let's see if we have any Q&A we want to hit. Aaron, you let me know.
I do.
All right, we got some Q&A coming in, and then we'll give you guys some contact info and some ways to learn more on this. But let's take your guys' questions.
Okay, so let's go through the best way to purchase gold. Thanks, Marianne. There are stocks that are gold, and then gold on paper, and then physical gold. How should I best go about investing in this with my IRA?
Good question, Dave. I'll let you answer that.
Yeah, so there's at least three categories that you could approach. One would be very growth oriented. Again, we go back to that perspective triangle, and on the growth side of the triangle, you could look at gold miners, gold and silver mining companies. These are companies that have, a free cash flow component. They have a margin component which expands with an increase in the price of gold, contracts with a decrease in the price of gold. And they do represent a reasonable way to approach having an allocation to metals, but it's not the physical metal. And you have to be aware of the other kinds of risk that are associated with it. There's operational risk, there's legal risk. We had a big copper mine in Panama, which the government, even though it was 5% of total Panamanian GDP, they just decided to shut it down. So there's extra risks from an operational standpoint that come with being involved in the miners. They can make sense. It's an area that we specialize in, and in our asset management group, that is something that we focus on. But that's different than a pure or physical gold exposure. You can buy an exchange traded fund, GLD, SLV. These you can buy like you're buying a stock. It is not deliverable. And so there are some components to that can be concerning. We would suggest that those are interesting trading vehicles, but there's still more fuzz on them than the actual physical metals. And so if you want something that is allocated, if you want something that is deliverable, which again, when you're taking sort of your required minimum distributions in retirement, you can actually have what is in your physical metals account with directed IRA. You can have that shipped to you. You can either liquidate it and have them send you a check, or when you're doing your RMDs, you can actually take that in kind. Cannot do that with an ETF. So there's added flexibility when you get to sort of that stage where you're taking RMDs. there's trade-offs with each category. I would say you're moving from sort of the outside where there's more risk to the inside where there's a lot less risk. And where we see gold become very popular is when people become very concerned with risk. So if you're not concerned with risk, maybe the ETFs are perfect for you. If you have things that register as concerns for you, then I think what you focus on for that insurance piece is the most basic, which is ounces, and they're for you.
One thing I was going to say too on the gold ETF, just the ETFs in general, is keep in mind they do have a fee that could be 1/4 to 0.5% that you're paying a year. So let's say you have 100,000 in that, you might be paying $500 of costs coming out of that fund a year. There's also, when you're buying and selling the ETF, there's still the bid-ask spread that's a cost in and of itself too. We're not actually getting the exact price. There's a spread, of course, in the middle there when you're buying and selling on the ETF. All right. One thing I want to note about too is just everybody, if you could show the slide here, Angel, just is just a call to action for everybody here to open an account with Directed IRA if you haven't already. I mean, if you haven't opened a self-directed account at Directed IRA, what are you even doing, guys? Take control of your retirement. That's what we're here to do. And our team truly wants to help. Right now, you get $150 off opening a new account, and you get access to the total self-directed IRA bundle as well as a special little perk right now. We're trying to do an incentive for any of you that need to get going, or any of you that have family or friends or other accounts you need to open. Let us know. Our team would love to help. You can go to directedira.com. We'll throw that link down in there, of course, where you can open up the account, and then you can also hit this QR code to get started. But we just want to give that little incentive to those of you here on the webinar. And then Dave, I'll let you, if you don't mind, giving us an update on your end on where people can reach you guys and get more information. I know we've dropped a link in the chat, but if you could unshare the slide there, Angel, so that Dave can get on and tell us a little bit about how people can learn more about McAlvany.
Yeah, McAlvany.com/directed would be the place to contact us. The McAlvany.com website takes you to kind of all of our properties, but our specific initiative with Directed, love to get in touch with you and know how you found us. And been doing a podcast for 18 years every week. If you're interested in macroeconomics, if you're interested in market dynamics, we've got some great guests that come on each week, and great way just to be educated about what's going on in the financial markets as a whole. And of course, gold factors into that. But we love to educate, we love to teach, we love to inform and empower investors.
All right. Well, thanks so much, Dave. I appreciate you coming on, sharing your insights on precious metals. Thanks for everyone here. Those asked questions. Remember, those will be recorded. So this will be up at directedira.com/webinar. You can get the directedira.com website. You'll get, if you registered for this, you'll get a reminder for this once this goes live. And make sure you're signed up for our newsletter as well at directedira.com. You'll get updates on upcoming webinars, other educational events that we have. We appreciate you guys being on. Until next time, stay calm, self-direct on.